welcome everyone. Thank you for coming to the Endeavor 10th Majlis today. We have a great group of guests here in Riyadh who are attending physically, but also we have audience from the online. In the next hour and so, we're going to have a great discussion about the journey of fundraising from post-seed to Series A. Our guest today is Jeffrey Bussgang. Jeffrey has more than 20 years experience in the VC. The fund that is being managed by Jeffrey, and he started the fund, have an asset under management of around 700 and almost 200 portfolio companies. So a great experience and exposure. Plus, Jeffrey and is a professor at the entrepreneurship school at Harvard Business School. So before we start, Jeffrey, why we want to discuss the topic today, and we think it's it is the time for the region and the startups and the founders and the funds in the region to think how we can unlock the potential of all the seed startups that we saw in the last few years, especially last year and this year, and then accelerate the growth of those startups so they can scale quickly and raise bigger late stage rounds, which will then move the whole ecosystem from being, at the early nasal days of any ecosystem to more mature ecosystem where more money will flow in, and then also more exits will validate that the ecosystem really works. So I will not take much time. I want you to jump in the topic and the presentation, and we will have less time maybe, but we will accept questions. So I invite all that who can hear us online to ask questions in the chat. For those who are in Riyadh, you will find a barcode where you can open and write questions, and we will be using those to have the conversation together, Jeffrey, as you present and after presentation. Welcome, Jeffrey, to the Majlis, and the floor is yours.
Well, why don't I jump in, if it makes sense, and begin my presentation. The goal here is to provide all of you with a bit of a backdrop on what it takes for entrepreneurs to raise outstanding Series A and Series B financings, particularly entrepreneurs in the region who are trying to attract international investors. And I have a number of slides that I'll show you that frame this question of how is it that entrepreneurs in the MENA region can raise exceptionally strong Series A and Series B financings. And my background, just again to summarize, I started my career as an entrepreneur and then moved on to become a venture capitalist after successfully taking one company public and selling one company, both venture backed. I teach here at Harvard Business School, entrepreneurship and venture capital, and I've written extensively on the topic, authoring a couple books, one Mastering the VC Game, another Entering Startup Land. And I'm a practitioner. I have a team that I work with that makes investments in venture capital, mainly seed and Series A. So I have over 150 portfolio companies that I've seen over the last 20 years go through this cycle. And what I think is really fascinating for me is thinking about your opportunity. Because if I look at the region that you're in and I contrast it to the LATAM region, and Latifa earlier talked about the fact that Argentina and Buenos Aires had this multiplier effect. Recently there was an analysis done of 25 unicorns created in Latin America. And I looked at the 4 largest countries in Latin America, Brazil, Mexico, Argentina, and Colombia, and I compared them to the GDP of the 4 largest countries in your region. And what I saw is that in those 4 countries in LATAM, there's $3 trillion of GDP that's being transformed digitally. Hence the creation of 24 unicorns in the last year or two. In your region, you have $2 trillion of GDP in these top 4 countries. So pretty similar, only a bit smaller, but only 3 or 4 unicorns created. So there's a massive opportunity clearly that exists for MENA entrepreneurs to seize this opportunity to transform your economy. And so what will it take to raise capital to seize that opportunity? I just characterize here before I begin a few patterns that, just so everyone's on the same page in terms of the language. You know, the pre-seed round is that first round of a few $100,000, friends and family in the form of a safe note perhaps, as compared to the seed round of $1 million or $2 million, and then leading to the Series A of 5 to 10 million and the Series B of 20 to 40 million. That's the typical progression. And you see international investors come in at the Series A, Series B stage, whereas local investors are often the ones that support companies at that seed and pre-seed stage. At the Series A, you have the intersection of the two, and we'll talk about that in a minute. And one of the things that's really important to understand about the venture capital industry is the power law. If you take the mindset of the venture capitalists, what are they looking for? What are the international VCs looking for? They are looking for outliers. The world of venture capital is defined by your winners. There are ridiculously large returns to the right of the distribution curve. It's not a bell curve with an even distribution. It's a power law curve with a few really extraordinary outcomes swinging the entire market. And so when investors are looking at your startups, they're asking themselves, is this local class or world class? Could this really be to the right of the distribution curve and a multi-billion-dollar company? And with that question in mind, they also wonder, does the entrepreneur understand that capital is a means to an end? Even at the IPO, IPOs, public offerings, are financings to build an enduring company. And so every one of these steps of capital raising is just a means to an end that you have to go through. So how do you get to that point of being able to raise an outstanding Series A or Series B financing? We're going to cover 4 topics in my brief comments. First, who are the Series A, Series B investors? How do you sell the dream to them? How do you speak to them like an analyst, since they're all very analytical? And then finally, how do you run a process? And I recognize I've got people online and I've got people in the room. So I'll try to keep this moving quickly to keep everyone engaged. And then at the end, we'll take questions under Ahmed's leadership. So first, remember that Series A, Series B investors have 2 mindsets. They have their heads in the cloud and their feet on the ground. Heads in the cloud, meaning they're dreamers. They want to know your vision because they want to believe you can achieve something that will be to the right of the distribution curve, that will be a multi-billion-dollar company. At the same time, they're very much investment analysts. At the stage of Series A, Series B, their feet are on the ground. They're looking for metrics. They want to know if you've been rigorous in your market analysis, in your analysis and assessment of product market fit, your differentiation, your business model. All of these MBA style questions you'll get at the same time that you'll get these vision questions. And it's this weird dichotomy at that Series A, Series B stage. Head in the clouds, feet on the ground. You as an entrepreneur have to be great at both. There's no way around it. And finally, they have fear of missing out, FOMO, and a competitive dynamic. Because if you're going to be one of the handful of unicorns in the region, then the international investors want to pick you. They want to be behind the winners. And they want to own a large chunk. And they want to have confidence that you're going to be that story that everyone can talk about, like Kareem or Getter. So that's the dynamic. So the best Series A, Series B entrepreneurs speak to all 3 of these issues. First, they articulate the vision and provide that dream of massive market domination. Second, they back it up with facts and data and good analysis. And third, they run a process that creates competitive tension. So how to do each of these 3? First, I'm going to talk about selling the dream. And I show in the next few slides a couple of real slides from multi-billion-dollar companies and their financings at the earliest stage. This is a slide from Zuora, which is now a public $2 billion market cap company that provides subscription management services for e-commerce companies. And what they did effectively with this one slide is they attached themselves to an inevitable trend. The world of innovation is about catching waves. And if you are a startup that can link yourself clearly to investors, to an inevitable trend, a secular wave, a massive shift in the world, then you're going to have a better chance of raising money. Here you can see their articulation of the shift from product relationships to customer relationships, and subscription services therefore being a natural extension. The other way that you can position your company as you articulate these trends is to grab onto a massive secular trend that's growing fast, and you're just going to grab your share. This is an actual slide from Square. Square, as many people know, is one of the largest fintechs in the world, over $110 billion market cap. This is one of their actual slides, even though it's very detailed and has a lot of data to it, where they said, look, mobile payments is a massive trend. And we as a fintech, we're going to grab a slice of this massive growth trend from 16 billion to over 200 billion. And as long as they can jump on that trend, they're going to be a winner. Similarly, this company, Elvest, which is a fintech focused on female executives and providing wealth management services for women, they said, hey, we're articulating a massive untapped market that the incumbents don't serve. So that's the big trend, this shift from women getting wealthier, but banks failing to serve them. And then finally, you can articulate a trend that's a new category, that's a new secular shift in the way people live or work or play or eat, but one that is completely underserved today, as in this case, Airbnb. Airbnb, which as everyone knows, is an incredibly successful $100 billion market cap company. They tapped into this trend of consumers wanting to take trips in a low-cost fashion and tapping into this excess supply. This is a slide from their actual Series A pitch deck. So this is the essence of how you position the dream, getting onto a wave, catching the right wave, and making it look like it's completely obvious and inevitable that you're correct, that the earned secret, the core insight that you have is one that's a part of a massive secular shift. So that's the dream. So to sell the dream, the other thing you have to do is you have to make them love your team. And this is so particularly critical for international investors, because this distance that requires trust, requires credibility, requires a sense of confidence that you can execute on that dream. How do you establish that? Investors want to know why you and why now. What is it about your background, your insight, your experience that suggests that you're uniquely positioned to win in this market? The relationships that you establish with those investors really matter. This is not transactional. You've got to establish these relationships over a period of time, and it takes work to do that. The other thing you need to do is get used to selling your team over Zoom. It's just the reality of the world we're all living in. Many investors now want to do first meetings over Zoom, and it's lowered the barrier. We can now more easily get access to international investors thanks to Zoom. We can understand, therefore, these quick hit meetings, what they're looking for, whether it's a fit. Do they invest in MENA? Do they like your business model? Do they have anything competitive or analogous in their portfolio? But it means that you have to do shorter, faster meetings, touch points along the way. You can't bore them over many hours. You've got to give quick hits and establish relationships and credibility over time and execute over time, and ultimately get them comfortable with your market. You know, I was looking at this market and thinking about the massive winners that have emerged really in just a very short period of time. Trendyol, which is now worth $15 billion, Getter, $7.5 billion, Careem, $3 billion through the exit with Uber, and then Swivel with $1.5 billion. There are massive winners being created in this region. And so you should know those winners and tell their stories and help draw those analogies for the international investors so that they think the art of the possible can be expanded, that it's not a local class opportunity, but a world-class opportunity. To do that, the other final way to sell the dream is with extraordinary momentum. Series A, Series B investors extrapolate from few early data points. I show here two charts. One company that achieved that magical 100K in MRR over the course of 18 months, and one that did it in 10 months. Which company would you invest in? It's obvious. The greater the momentum, the faster the rate of change, the better the success you're likely to have with investors, because they extrapolate from these data points. Rate of growth is incredibly critical. So you want to sell the dream, attach to an inevitable trend, and link to analogies. Analogies are very powerful in our business. And I give one example here. They anchor your business to other valuable businesses and set that mindset. So for example, I'm an investor. My first MENA investment is in a former Harvard student of mine, Yasmin Abdel Karim, who founded YFS, Yalafel Seka, which she describes as the Instacart and DoorDash for the MENA region starting in Cairo. Very simple pitch. Instantly you think, okay, Instacart, $39 billion company, mainly US focused. Many other delivery companies, very valuable. DoorDash, $70 billion market cap, incredibly valuable. Still a huge amount of expansion left. If you can be the blank of blank in a particular region, just like Kareem achieved with Uber, you can immediately get investors to understand what you're trying to build and create that association of value creation. So the steps to creating a dream: the trend is your friend. Pick a massive market, get them to love your team, show a lot of momentum, and then use these analogies and proxies to create a very compelling story and narrative that gets them excited. So that's the dream part of the equation. Now let's talk about the analysis part of the equation. Head in the sky, feet on the ground. Series A, Series B investors are investment analysts. They need to walk into an investment committee with their partners and convince their team that they should invest in this company, maybe in the region that all of you are in Saudi Arabia, or in the MENA region more broadly. And to do so, they need metrics, they need data, they need references and social proof, and they need early evidence of product market fit. That's what's required to really convince a partnership that they should invest in you. So how do you build internal support for that individual, that partner who you convert to being a champion, and then take that champion to their investment committee? And the key thing for you to do as an entrepreneur is make their life as easy as possible by effectively writing the investment memo for them, giving them all the data they need to write that investment memo. And I share some of that data here that I've culled from looking at investment memos from dozens of my peers in the Series A and Series B stage. And by the way, these slides I'll make available so that you all can see them and refer back to them. But really help coach the champion to make the case. And in so doing, look for those extra things. I made this reference to local class versus world class. They're going to wonder, do you really understand the successful business models out there in the world? And do you know how to apply them to your market? And I'll give you one example to that. I'm an investor in Madeira, which is the Wayfair of Brazil. Wayfair is a #2 largest e-commerce company in the US, $35–40 billion market cap. And this phenomenal Brazilian entrepreneur from the industry, so amazing founder market fit. His parents were in the furniture business. He built the home furnishings leader in Brazil, more specifically, Brazil, LATAM more generally. So what was so amazing about this entrepreneur is that he learned the Wayfair playbook. He went to Wayfair, and I'm an investor, I confess, so I helped him with this, since the Wayfair founders are friends and personal investors in my fund. But we got him in front of the Wayfair supply chain team, marketing team, merchandising team, and he learned and studied their playbook and then translated that playbook for the local market. And that incredible studious approach of understanding the world-class global business model nuances and details of the leading players, but then translating those elements to the individual local market, which only you know best. Your investors don't know them as well as you do. That's really the most impressive way to demonstrate the extras that the international VCs are looking for. Have you studied the international playbooks? Do you know about lean, the lean startup theory, customer discovery, 4 steps to the epiphany, product market fit, all of these elements that are part of the global knowledge diffusion world of startups and venture capital and innovation. The last thing I'll say is trust and transparency is incredibly important. People, the investors, they want to see no special deals on the cap table or in the P&L, no bells and whistles. They want everything to be very clean. We have a phrase in my business about clean deals. We want deals to be very clean, very straightforward, so that entrepreneurs are not misaligned with investors. So you've got the dream, you've got to be a good analysis. To be a good analysis, you've got to have phenomenal command of all aspects of your business. Do you know the key markets and metrics for product market fit? Do you know how to articulate the case studies of your customers and to talk about customer personas to really bring it to life? Do you have the traction, and do you know about the traction? Are you familiar with the details of these elements that all investors will ask you about? Monthly recurring revenue, annual recurring revenue, your average contract value, your sales cycle length, your average contract length, your pipeline, and is it growing over time, and what's your pipeline coverage, customer concentration, your churn, your retention, logo churn, gross churn, net churn, your lifetime value over customer acquisition cost ratio. Is it better than the industry benchmark of 3? Is your payback period less than 12 months? What does your growth rate look like and your engagement in terms of monthly active users, weekly active users, daily active users? I'm throwing a lot of these jargon terms at you because this is the language of the investor community. This is the language that we speak in shorthand. And if you want to excel in attracting capital, you need to speak that language. You need to know your business. You need to have these metrics and the benchmarks at the tip of your fingertips. The other thing that people will ask to determine, is it a big opportunity? Does it have the potential to be the right of the distribution curve? Is your ultimate market size? Is your total available market, or your TAM, and your serviceable available market, your SAM? That is not just the total market, but of that total market, what percent fit the value and the solution that you're providing? Is it massive? Can you really provide evidence of not only the top down, but the bottoms up? There's a question that one of my VC friends likes to ask all entrepreneurs, which is how many of the Fortune 1000 companies, for B2B entrepreneurs, but how many of the Fortune 1000 would buy your product? And then tell me, how much will they pay on average 3 to 5 years from now? Because in their head, they're doing the bottoms up math on how big could this be? Is the market growing and changing? Is it dynamic? Those are the questions you're going to need to answer. And then also, how are you different? And what is your sustainable competitive advantage? Why are customers making the decisions they're making? Are there strengths that your competitors have, but you can sort of parlay and describe where you're stronger? You do the classic 2x2 that all BCG and McKinsey people do to show that you're up and to the right. Just showing this articulation, whatever those momentum points are, that you understand the competition and you're far superior to them. The final thing they'll ask you is how much and how fast. A clear view of how much money you're raising, what you're going to do with that capital, and how will it produce the outstanding investment results that they're expecting. So, what will lead to a significant increase in valuation? I refer to those as valuation inflection points. If you raise $10 million, after that 10 million is done, let's say it's done at a 50 million post, when that 10 million is done, will you be worth 100 or 150 million? Can you demonstrate clear signs that you'll have a 2 to 3x? Again, this is something you need to show them to help them build the memo. So what's in that deck and why is it so critical? The memo tells the narrative. It tells the story of how you're going to articulate that dream and that vision, and also the tangible metrics that you have achieved already that show evidence, if you extrapolate, that this is going to be a massive winner. So it's both storytelling, but also a capacity to show analytical skills and show you're really sophisticated about financing processes. After those first few meetings, you'll get asked for more data. Remember, Series A, Series B investors are analysts at heart. They want to hear the vision, but at the end, they have to be analysts to write that investment memo for their investment committee. So for B2B companies, there are a number of things you'll need to show them. For B2C companies, a number of things you'll need to show them. Common among both: historical financials, unit economics, LTV to CAC, cohort analysis. In the B2B context, you'll see more questions about sales pipeline and sales process and payback period. They'll want to talk perhaps to a few customers, large customers, your top 3 to 5 major customers, and they'll want to see your product roadmap. In the B2C context, it's going to be more about your repeatable customer acquisition channels. Are they scalable? Are they paid or organic? What's the gross margin analysis, and how does that vary over time? You want to get ahead of your investors, anticipate the questions. What always impresses me and my team is when we ask entrepreneurs questions and they have the answer immediately in the form of robust, well thought out material. So I say, show me your cohort analysis, and they don't look at me quizzically and wonder, what do I mean by that? They send to me an absolute beautiful spreadsheet articulating every single month, every single dollar amount by month, by cohort, and how that's varied over time. When I say to them, show me your LTV to CAC analysis, they don't do the calculation sloppily. They send me a beautiful spreadsheet with a very well thought out, detailed analytical framework with using all the best practices when it comes to calculating lifetime value and customer acquisition cost. So again, being very prepared to be the analyst. And then the final thing, as I said earlier, Series A, Series B investors, they have FOMO. So you got to run a great process. You got to create scarcity, momentum, and inevitability. There's a VC introduction algorithm. VCs depend on certain people to make introductions, and whoever makes that introduction, it says something about you as an entrepreneur. Entrepreneurs in their ecosystem who have made the money or who they've invested in, they're at the top of the criteria for VC introductions. When I have an entrepreneur who's made me money call me and tell me that there's another great entrepreneur I should meet with, I drop everything to meet with them. Further down the hierarchy, other investors that they respect, existing investors that have written a check and voted with their feet. Lower down, maybe service providers. At the bottom, cold emails or investors who have passed. There's nothing worse than a cold introduction from an entrepreneur. So if you're trying to reach some of these international investors, work your way to the warm introduction. As one of my friends likes to say, if the entrepreneurs can't get to me through a warm introduction, how do I know they can be great at recruiting a team, world-class at recruiting customers and partners, and amazing at follow-on financings? So, show the evidence that you can get to investors through your network. The Endeavor network is gold in that regard. Your early stage investors hopefully can be very capable and helpful in that regard, but really work the network strategically. And then remember the investor decision tree. Every investor has to spend very little time on a lot of things. I get thousands of business plans every year that I have to sift through to make a handful of investments. And that multiplies across my partnership. So imagine when you come in cold, hopefully not warm, hopefully a good, strong introduction, that I'm filtering. I have to determine very quickly, is it worth spending time with you? Is it worth taking the 30-minute, 45-minute Zoom to hear about your business? Because I want to spend a lot of time with very few entrepreneurs and very little time with a lot of entrepreneurs. And that's how all investors are. So make sure you're really thinking through getting through that investor decision tree to get to the point where they're doing serious due diligence on your company. So look, guys, just as in conclusion, as I talk about processes, there are really two kinds of financing processes. One is where the process is preempted, where in my portfolio, I see this with my best companies, where investors come to them and say, I've been studying the sector, I've been studying you, I hear about you throughout all these great entrepreneurs in my network, I'd like to invest in you. One of my companies just recently received investment preemptively from a phenomenal CEO-led fund in Silicon Valley at 2x the previous price, only 4 months after our investment, because that CEO and that fund said, We believe in this category. We've been hearing about you guys. We want to preempt. That's the dream. Setting yourself up for a preemptive process, maybe doing that with 2 or 3 investors so that one of them, creating competitive tension, but one of them steps forward. Or more likely, you do an orchestrated process where you go to 10, 15 investors and try to get a few nibbles and build momentum. And you do it in waves and very strategically. So on the preemption side, I would just say always be ready for a preemptive process. Have your data, talk to those investors, build relationships, talk about the fact that we're not fundraising, we're just having some meetings, we're not really looking yet to raise, we've got plenty of runway. That's when you really know that you've got them, is when they want to keep taking meetings with you, even though you're not technically fundraising. And just make a sense of what the valuation that you think is fair. Don't push it, and then see if you can get that in a preemptive process. Actual timeline for a preemptive process, it can happen in 45 to 60 days. Inbound interest, you get some outbound conversation, due diligence, term sheet, boom, 40 days, 5 days, 60 days, you can close a financing through a preemptive process. It can be very fast. It helps to have the groundwork laid and those relationships in place. And then the orchestrated process, that's where you've got to have a lot of materials. You've got to be very prepared, have that data room, be very buttoned up, get ready for those big partners meetings once you get past that stage. And that's going to be more like a 6-month, 4-month process. It takes time to get the engagement with people who you may not already know, who don't know your sector, who don't know your region, and having them be willing to step up and lead the financing. Some brief hacks, and then I'll wrap for Q&A. First I'd just say do your homework on the investors and the very particulars of the GP, their portfolio, the firm, their portfolio, what the networks look like, and how they might overlap with your network. Again, Endeavor is magic because there's so much information about the international investor community in the Endeavor network that you can tap. The second thing I would say is, just like you would a project, a major product, a major launch, develop a timeline, build out milestones. Financing processes are just like sales processes. You want to have strong pipeline, lots of project plans, lots of details, have some press hit at just the right time to build momentum, have a couple sales be ready to go. One of my favorite things is when the CEO walks into our board meetings and just spontaneously says, "Hey everyone, I'm so glad to announce we signed this first contract with such and such, our major, first customer." Timed beautifully for the board meeting. Imagine the odds. So think about sequencing and developing those capabilities so that they come in the right time. And really, find out what gets investors excited. Ask about those particular investors in the international community so that you know what they're excited about. Final point, and then we're wrapping here, but always know your burn rate, always know your cash out date, and make sure you're planning for that fundraising process 6 to 12 months in advance. Do not get caught short. CEO's most important job, founders' most important job, do not run out of cash. So that's the essence of my presentation, everyone. Great to be with all of you. I will pause now here and take questions from the group and see where you want to go. Okay, so I see a number of questions, and because of the echo, I think I'm going to do them myself rather than ask Ahmed to facilitate. So, one question is about investor behavior in the context of COVID. And I would say that investors are willing to make investment decisions online over Zoom and Teams and Google Meet more and more. At the same time, as I said earlier, you want to have a lot of touch points to build trust and credibility. And so whereas before in in-person meetings, you might have had half-day meetings, going through due diligence, 3-4 hours in a room, piling through the numbers together, shoulder to shoulder. You can't do that today. And so the reality is you have to have more frequent, shorter meetings. all of our attention spans are short. Even this conversation over 30 minutes or 40 minutes, I'm sure many of you have looked at your WhatsApps and your phones. I see you. I know you're doing that. I get it. It's why in my HBS classroom, I say no devices. Everybody must be in the classroom, present and focused. But look, online, people are distracted. Investors are distracted. You're distracted as an entrepreneur. So shorter, quicker, tighter meetings, much better as the way to proceed. Another question I see here is that change, that transition from seed series, stage, pre-seed angel stage to the professional institutional Series A, Series B, and some of the biggest challenges for entrepreneurs. As I said earlier, the best entrepreneurs are able to be in that dual mode, head in the clouds, feet on the ground. Unfortunately, many of the best entrepreneurs who are great visionaries are not great tactical executors. And so my advice is, if you can't play that role yourself, and very few can, if you can't play that role yourself, make sure you've got a team that can do that. So maybe you're the visionary, but you have a number two, a chief operating officer, a CFO, who's the detailed analytical brain, so that you can stay focused on vision, and others maybe driving the numbers and showing the unit economics and the cohort analysis and doing the P&L. Too often I see founders try to do it all and not have the right skill set. This is not, some founders have a hero complex where they try to be the hero and try to do everything themselves. And as companies scale to Series A, Series B, founders have to not only build great teams, but delegate and empower those teams appropriately. Another question I see is around financing detail and structure. Is it okay to have multiple caps on the same round for multiple investors? So on that one, guys, I would say the simpler, the better. I made the comment earlier about the fewer bells and whistles, the better. I think you're better off having a clean, simple, single cap, single safe note, raise that financing, go away for a year to 18 months, execute, make progress, and then come back and raise another financing. You don't want to layer too many safe notes on top of each other. And here's why. Safe notes have caps, not floors. Means they're good for investors. The investor price exposure is capped, but the entrepreneur has no floor. The price of the next round could drop down dramatically, and then everything previously converts into that cap. So that's a very dangerous situation to be in. So you want to have maybe one round with the cap, and then after that, you want to price the rounds appropriately. That's my advice. And I would use the NVCA standard forms, get a lawyer who's very familiar with VC deals, and just keep them as clean and simple as possible. I saw a note that I should wrap. So maybe I will do that. It's a pleasure to be with all of you. I'm sorry. I know there were some technical difficulties, but this has been a great conversation. I see a note I can answer one more. So the question is, in early stage investing is a lot of unknowns. After qualifying team, market, tech, what else can you consider to improve early stage decision making? I think the thing that I look for is I like to invest in movies, not snapshots. And what I mean by that is I want to see multiple data points over time. I want to see the fact that a team can execute over a period of time, not just in a given moment. And one of the things that's hard over Zoom is we're seeing a lot of snapshots, and we have to make decisions very quickly because the market is very robust. My preference as an investor is to really take the time to build relationships and see teams execute, see them build that trust and credibility, and then jump in. Now, as an early stage investor, that means you have to see them very early when they're young, it's a benefit I have as a professor at Harvard, where I get to see the students as they come through. I can see the students at MIT, but really seeing them at a young stage and age, getting to know them and watching them prove themselves over many cycles and many rounds to know that you can trust them and ideally invest in them. So that's what we look for as we look at reducing risk over time, team risk, market risk, technical risk, and execution risk as the periods continue, so that when you're at that Series A, Series B stage, those risks are all by and large gone. Maybe you have a little bit of execution risk at scale, and now you're talking about really, in addition to the execution risk, building a repeatable and scalable machine. So that's the dynamic. So let me wrap there, guys. Been great to be with all of you. I'm very bullish on this region. I should tell you that personally, I invested in the China region as a personal investor in some VC funds 20 years ago, because I saw China developing as this amazing emerging market. 10 years ago, I began investing in Southeast Asia and LATAM, Brazil, because I saw Indonesia and Southeast Asia, Singapore and LATAM, Brazil, Argentina, Colombia, becoming these really interesting emerging markets. Both China, Southeast Asia, LATAM have proven repeatable unicorn production, repeatable major startup, major value creation. I'm excited to see the MENA region follow in that same path. I don't think there's anything holding you all back with the culture, with the technical talent, with the intellectual capital. There's just a tremendous amount of opportunity ahead of you. So good luck, guys. Great to be with you. Thank you so much, and look forward to more dialogue ahead.